Well, one of our traditions is the Bank of England, the old lady of Threadneedle Street. But the governor, Andrew Bailey, came out this week blaming everybody else for inflation other than the bank. He started with early retirees, and he's also blamed pay rises for inflation and told people not to ask for pay rises, and he's told businesses not to put their prices up. He seems to be blaming the inflation that we have on everything other than the Bank of England's monetary policy. And it's worth remembering that things like pay rises are a symptom of inflation rather than the cause. So isn't it time that the governor and the bank took responsibility for not changing monetary policy and increasing interest rates earlier? So, who better to have with me, possibly to be more defensive of the bank than I am, than the very distinguished economist, Mr. Roger Bootle. Roger, thank you for coming in. To what extent do you think the Bank of England's mistakes are at the heart of the inflation that we've got?
Well, I do think, Jacob, you are too hard on them, actually. I mean, there can't have been a worse time, frankly, to be a central banker. We had the global financial crisis, which caused havoc throughout the world. Then, of course, we had a series of things go wrong. We had COVID and lockdowns and so on and so forth. And looking back, it's always easy looking back to say, you know, they should have done so and so. Having said that, yeah, I am critical. They kept rates too low for too long.
And didn't Carney keep on saying in the mid-2010s that he was about to raise interest rates? Wasn't there the unreliable boyfriend commentary about him? He was always promising to do something. He gave advance warning and never then delivered, and that kept the zero interest rate policy for far too long.
Yes, I think that's right. I think the roots of the current problems go back quite a long way. Interestingly, the Bank for International Settlements, based in Basel, Switzerland, has for years been saying that this policy of very low interest rates is going to sow the seeds of the next financial crisis, and of course they were ignored.
Indeed, and we then had the extra dose of quantitative easing during the COVID pandemic that put a lot of money out when supply chains were already tightening, demand didn't go down as had been anticipated, just adding fuel to the inflationary fire.
I agree with that. I mean, my own view is that actually the very low interest rates were more important than QE, but of course they were both in the same direction, and they were both kept on at too great a level for too long. But I think the governor, to defend him briefly, I think the governor, I don't think he put it very well, but I think he's right in saying that this problem arises as a result of the interaction between aggregate demand and aggregate supply. And the bank has got an influence over aggregate demand. It's got no influence over aggregate supply. And it was in the business of boosting demand, and it didn't seem to notice, actually, not until very late, that aggregate supply had been nobbled as a result of COVID.
But on the supply and the supply of labour, one of the reasons people are retiring is that because of zero interest rates, asset prices have been an absolute bubble. People are selling their houses, moving to smaller places and retiring on the proceeds. It actually comes back to interest rates.
Well, I think some of that is right. One should note that this isn't only a British phenomenon. I mean, we had high inflation in Britain and higher than in many other countries, but essentially this is international. So we should be looking, I think, for international explanations. And the explanation that appeals most to me is COVID and its consequences, one of which you're referring to.
And isn't it also, in terms of the international consequence, that actually the Bank of England, though very important, can't fundamentally have a different policy from the Fed, because the power of the Federal Reserve is so great that a central bank that had had much higher interest rates in the 20-teens would have found that their currency would have become enormously expensive, and it would simply have had to have given in. And that's the best defence of the Bank of England.
Yeah, it's one defence. I'm not sure I go all the way with it. It would have been possible to have run a different policy from the Fed, and there are times in history when the bank does diverge by quite a lot. You're right about the exchange rate, but there's something more fundamental, I think, again, to give the bank the benefit of the doubt, or at least some of it. It's not easy, and what annoys me about the monetarists, and I'm not a monetarist, is that they push this idea that there's some painless way of controlling inflation. You just control money supply and inflation subsides gently. I'm afraid it doesn't work that way. Insofar as monetary policy does control inflation, it works through inflicting pain. And obviously the Bank of England didn't want to do that. It didn't want to send the economy into recession. It still doesn't. And it's a very, very difficult judgment to make.
I absolutely accept that. And you get into the issue of the zombie companies, and it is politically helpful to keep zombie companies going because they provide employment and avoid people having potentially homes repossessed if they've guaranteed loans. Nonetheless, zombie companies misallocate capital.
I think that's right, and that's a particular aspect of something that central banks in general, including ours, have, I think, downplayed. In economics, there's a thing called the Austrian tradition. And the Austrians, some of whom were Austrian, they weren't all Austrian, look at that label, always talked about this, that the long-term consequences of the misallocation of resources as a result of government intervention going too far. And it didn't receive enough attention, I think, particularly in the years after the global financial crisis. You can do things, I think, to boost demand, which sound quite good in the short term, but cause all sorts of long-term problems, and that's what I think's happened.
And in terms of the moves in interest rates we've had so far, one thing that I'm really interested in, I don't know the answer to, historically, to crush inflation, you've needed to have positive real interest rates. But this time, you've seen the interest rate go up from 0.25% to 4.25%. This is a massive percentage move. Is that enough to reduce demand? Because real interest rates would massacre the economy, wouldn't it?
Well, Jacob, you're asking all the right questions. I'm worried about this. The size of the increased interest rates is absolutely massive, but you're right, we haven't got positive real rates. And in the past, we had to have positive real rates. I think positive real rates in current circumstances would be devastating. That would be Armageddon. We can't go that far. But I'm worried that most people, including the people on the Monetary Policy Committee, many commentators, many people in the city, have, I think, fallen for the idea that we can actually reduce inflation fairly costlessly, comfortably. They've fallen for a comfortable illusion. So my suspicion is that rates are going up rather more than most people assume.
And that will be during the course of this year?
Absolutely.
And the banks, because we've obviously seen one bank already having to be bailed out, are there more bank bailouts as they find their assets and liabilities mismatch?
Well, of course, you never know until the thing actually happens. I think British banks are genuinely in a much stronger position than they were at the time of the global financial crisis. And SVB was, I think, operating quite close to the margin in a rather dodgy way. Credit Suisse, we know, was badly managed for years. I hope this is not just a hope.
We're going to have to come back to this because I've got to pass on. But thank you, Roger. Really informative. So glad you came in.